wrote another article. I'm screen sharing to Dukascopy website where my article sits, so I guess I will be good without uploading same slides here on the whiteboard. So this is a third article in a series called Likerty, why traditional technical analysis tools such as trend lines, moving averages, and various indicators are better to be avoided, as there are other reasons which moves the markets. And in every article I'm taking one of those most widely used technical analysis tools. In this third article, I'm talking about indicators, and you can find all my reasoning, all the factual, all the facts which should be in mind for every trader who tries to apply them. So of course, indicators is a very wide term. I'm focusing on those price action based indicators like RSI, like MACD, like Shimoku, Bollinger Bands, and similar ones, who are theoretically designed to find entry signals for swing or positional trades. I'm not arguing about other type of indicators who are designed to automate to make some other who are designed which are designed for other functions like automized drawing and calculating of various other technical aspects like calculating average daily ranges, drawing automatically pivot areas, pivot levels. There are indicators which tracks correlations in between different instruments. So I'm not talking about those types. I'm talking about those which are designed to give you a clue when to buy or sell. So one of the worst things about indicators, and many others, especially moving averages, that they look nice on historic price action. You can see some old price action and see how our price reacted every time it crossed some stupid line. It moved there, then it reacted to some other stupid line and moved there. But when you try to trade real time, when you need to make those stressful real time trading decisions, it's difficult to determine when price actually established above or below the trend line or indicators case moving average. Oh, often those are moving average based indicator, but whatever. This is a line, as in this example, RSI indicator. There is a line which follows the price. And when you watch real time, sometimes you can see a cross into, let's say, oversold or overbought territory. Then it crosses back and forth, and you see some, let's say, you have Shimoku cloud or whatever, and you see some sort of break above the line or the cloud, then coming back, and often the price pierces back and forth to the level before establishing below or above it. And it gives plenty of false signals. And well, even with small losses, those quickly add up and makes trading very stressful and tiresome work. And well, I noted that especially in public forums and newcomers discuss their trading systems based on and their analysis based on various indicators. They forget the fact that indicators, moving averages, trend lines, they follow the price, not the other way around. It's not the price which follows indicators. So if suddenly some candle spiked up, indicators also spikes up, but it doesn't mean that it won't spike back again. Also, one interesting point is that some major, most popular indicators like airtime, for example, sometimes could be used as a contrarian indicator. And in this particular example, I'm showing pound daily chart, pound dollar here. This is a perfect example. Those are more common on an intraday basis. When price approaches some notable historic price action levels, like those highs right here and previous broken resistance, then you always consider maybe it's time to sell, to enter counter the trend. But in those cases when some mediocre levels are approached, because it is only a part of bigger bearish range, and essentially there are two major levels, highs and lows of the range, and those inner levels are really weak ones, and you have to be very cautious about trading against them. So when price really gives clues that, and there is a reasonable distance or potential for it to move even above the level, and you see those oversold or overbought readings, some extreme readings on any indicator, well, it's sometimes worthwhile to consider actually the opposite decision to trade with anticipation of the breakout. And if you ignore indicators or any trend lines that you could draw here, you gotta follow the most recent price action. In this particular case, and I mentioned on my webinars, which I'm broadcasting daily, that at this particular stage, pound started to show very strong bullish signs. It showed bullish signs previously, but at this part it started to confirm its future targets. It started to react to retracement levels of its future range, and especially when you see those strong bullish rejections, quite stable uptrend without much of a retracements on the way up, and especially that you see such double bottoms and similar rejection looking alike patterns near those levels, which some others might try to trade against them. But we actually should consider the opposite, and extreme readings on indicator actually would help us a contrarian indicator, showing that this is exactly the point and place to trade maybe breakout movement. So one of the examples, I had quite a few prepared for the article. I was too lazy to show them all, but this is one of the more beautiful ones. And if you follow the price action, you can see that since the last bull impulse point and the highs, there is a middle of the range. There are other levels which you could come up with, and in this example, it shows that how it reacts to this middle, which is one of the small confirmations that there is positioning going on for those highs to be attacked. It doesn't mean that it won't go lower, of course, but those are other technicalities which should be considered. But the point is that, well, all the answers you can find in the price action. Those green and red bars and candles are all you need, and some additional graphical calculations and all this nonsense is better to be ignored. And such charts like this one, this is also a pound daily chart again. This type of a chart reveals that there is a newbie on the wheel who tries to trade, and well, you can add as many as you want and those tools, but those are all lagging tools. Those are the most common that I've shown here: stochastics, MACD, RSI, Bollinger Bands, and Ishimoku. Those are the most useless ones, and ironically, the most popular ones. And I heard some argument that despite that indicators lag behind price action, they still could be used, they still could help. But well, really, it's like, you know, it's like defending with a banana in your hand against the attacker. What's the point of using useless tool? You know, it's better to clear up your charts and focus, zoom in and focus on what is going on intraday basis, on bigger time frames, and maybe you will see what the real story develops. And as I'm finishing my series regarding those standard technical analysis tools, I will start another mini series on a few separate articles, and I will explain more closely, more in detail how to read price, what are the principles which should be had in mind. And the main principle is quite simple. Of course, it leads to more difficult analysis, but you gotta follow a story which was told by the market mover entries. You see those impulse points, entry points in the market movers. You try to predict where they are planning to take their profits. You know, where are the other entry points, wait for confirmations, so on, and just follow the story, the developing story. And indicators is definitely not the way to do that. And as you can definitely get lucky with some profitable trades based on readings on those indicators, but it's a short-term play. If you want to really understand the markets, you gotta study the markets, not the indicator, but what price does. So that is my story for today. That's my article. So I hope you like it. I hope I will win some proper place in the first one. So that's it. If there are any questions, are there any questions? Okay, bye-bye now. See you later. Not later, sorry. I will see you tomorrow in my morning webinar. So good luck in your trading and have a good evening. Bye-bye.